talked about margin, thank you. We talked about marginal tax rate versus average tax rate as well. Thank you for reminding me. You guys recall that? That our marginal, it's gonna be whatever that last dollar of income, whatever bracket that falls into, that's our marginal rate. Average, we've gotta do a calculation. Tax, total tax divided, tax liability divided by taxable income to get our average rate. We talked about progressive, regressive, and proportional tax structures as well. Okay, just kind of a little reminder before we get to the appendix here. Did I leave anything out? Good memory there. Okay, so authority. How do we know that okay, so we have these taxes that are applied to us. Why do they get to be applied to, why do they get to take our money? Well, what's that? Right, so taxes fund the operations of government. Government provides services to the citizens of the country, and so that's what our taxes are going to pay. Now, there are lots of arguments about whether they're taking too much and what exactly they're being spent on, and we're not going to get into any of that political stuff. But at its core, that's the purpose behind taxation, is to collect funds so that it will be used for the greater good of the society and to provide services that are needed by the citizens, right? Now, in the US, we have different types of tax authority. The ultimate tax authority comes from the Constitution. The 16th Amendment of the Constitution says that Congress has the right to lay and collect taxes on income. And so that is the ultimate authority. It's pretty clear. But then we also have Congress that gets involved in making all of the rules about how that's going to happen. Okay, we know the government has the right to collect taxes. How are they going to do that? Who do they get it from? What types of income are going to be taxed? How is that income going to be taxed? At what rates is it going to be taxed? All of those decisions are made by Congress. So Congress gets to determine the specifics of how that is implemented, that collection of taxes. But then we also have, Congress doesn't get, even though the tax code is ginormous, it's a lot of information, it still doesn't give taxpayers specific information about how to abide by those tax laws. That's where the administration comes in. The administration, which is the IRS, essentially, makes the rules around how to implement those laws, how it's all going to be, specifics about how it's going to be implemented. However, sometimes there are arguments about that. Sometimes the taxpayer says, no, you IRS are interpreting the law incorrectly. You should be interpreting it in this other way. Well, that's when the judicial system comes into play. When there's some sort of disagreement between the citizens and either the administrative source or the statutory source, then the judicial branch will get involved with that. Okay? Does that make sense? This is your little civics lesson for the day on tax law. We're not going to get too deep into this. Your book does kind of go into the different legislative bodies that and the process for voting on tax laws. We've had a lot of tax laws. Tax laws get passed every year. Usually, we don't really hear very much about them. Every once in a while, though, there are some big, massive changes that happen to the tax code. Congress gets involved and they make big changes. Now, of course, it's not, we have two branches of Congress. We've got the US House of Representatives, and we've got the Senate, and then we've got the executive branch, the president. All three of those have to sign off on any laws in order for them to be implemented. But this is the process by which it starts. So it starts in the House. It's just like any other law, right? Tax law is just like any other law, except that probably fewer people understand it. But everybody thinks they understand. So all of the laws start in the House of Representatives. They get voted on there. They go to the Senate. They get voted on in the Senate. And then the Senate and the House get together and squabble about the specifics of it. It may have to go back to the House and the Senate to be voted on again. Then it gets, if it passes both, then the president has the choice of either signing it or vetoing whatever tax law, whatever law that is. Once it is signed by the president, then the Internal Revenue Service starts to get involved and then changes all of the wording, goes through the Internal Revenue Code and makes any changes to that code to reflect the new law, okay? The Internal Revenue Code, which is massive. Now notice it says revenue, it doesn't say income. So the Internal Revenue Code deals with all different types of revenue, not just income taxes. And you can see we have a lot of different types of taxes. Now the first part is about income taxes, but we also have estate and gift taxes that, most people in this country aren't subject to them, but they are still there. The estate taxes, somewhere over $10 million now, that if you have an estate and it passes to one of your heirs who is not your spouse, then there is a taxation on the amount that is over and above the threshold. Gift taxes and estate taxes work in conjunction with each other. Like I said, most people will never have to deal with either one of those. Employment taxes, that's Social Security and Medicare tax. Any taxes that employers collect. So that would also include unemployment taxes. So, and these are just the sections in the Internal Revenue Code that deal with each of these types of taxes. Excise taxes, which I don't know a whole lot about. Alcohol and tobacco taxes. And then there are some separate sections just about different parts that deal with taxation. It falls under the U.S. Department of Treasury that administers the Internal Revenue Service. Now, the last big change to the Internal Revenue Code was probably in 2017. It was passed, and there were a lot of big changes that happened in 2017 to the Internal Revenue Code. Fortunately or unfortunately, depending upon your personal opinion, a lot of those changes are currently being phased out. There is oftentimes when any tax law is passed, there are sunset provisions in those tax laws, meaning it will expire at some point. So one of the provisions that we had, it was only for 1 year, it was an increased child tax credit. Child tax credit is $2,000 per child. We had 1 year where it increased to $3,000 per child, $3,600 if your child was under the age of 6. But that was only for 1 year. Now, why would they do that? It all has to do with budget projections. And in order for those laws to be passed, they have to come in. It's politically unpalatable to pass legislation that is going to cost an exorbitant amount of money. And so what they do is they put restrictions on, time period restrictions on a lot of these laws. And right now, actually, a lot of the benefits that were, the tax benefits that were implemented in 2017 are currently being phased out. So people are incrementally seeing their taxes change. But that was probably the last big piece of tax legislation, was 2017. Let's see. So administrative, like I said, the the IRS decides how they're going to implement the tax law, and they put together different publications that explain to taxpayers and tax preparers how to interpret the law. Like I said, you don't have to agree with the IRS. If you disagree with the IRS, you just have to be prepared to argue that in court. And sometimes you win. Sometimes you win. There are times when the IRS is not correct in their interpretation. They will always err on the side of collecting more revenue, but they're not always right. Let's see. I'm not going to go into all these different types of. These are different types of publications that the IRS puts forth to interpret the laws. Judicial tax authority. So this is when the courts get involved. There are a couple of different ways that people can take, the IRS can take people to court, citizens to court, if they have failed to, usually that's a criminal court, if they have failed to pay the taxes that they think are due, but citizens can take the IRS to court as well. There are a couple different types of courts that they can, actually 3 different types of courts. So there is U.S. District Court, which is just, they hear cases about everything. Criminal cases, bankruptcy cases, tax cases, all over the place. They don't specialize. U.S. Court of Federal Claims, so this would be like civil cases that are heard there. And then there is this U.S. Tax Court. U.S. Tax Court is comprised of judges who specialize in tax. They know their tax law. U.S. District Court has judges that may or may not know tax law, right? So these are just different courts that can be utilized. All of them ultimately, if they're appealed, could go to the U.S. Supreme Court. It's not very often that the U.S. Supreme Court hears tax cases, but every once in a while they do. And like I said, the IRS doesn't always win. Questions about that? Okay. So let's take a quick look at Appendix B here, which talks about the different rules for paid tax preparers and penalties associated with breaking those rules. Now notice it says paid tax preparers. If you, hopefully some of you will be participating in VITA this spring. I'd love to have you join me on Fridays, where we get to actually prepare tax returns for the public. Now these are unpaid positions. These are, you get credit for it. I mean, it's a credited class. I think it's a 3-credit class or something like that. And it ends the end of March. So that's always appealing to some students. But that is a volunteer position. So it's not a paid preparer position. So those rules there are rules that apply to it, but the rules that I'm going to talk about here don't involve those who aren't being paid. If you do that out of the goodness of your heart, you help your parents or brother or sister prepare their taxes, you're not getting paid for it, those rules don't apply. This is only if you actually get paid to prepare taxes. And these are rules set forth by the IRS for those individuals. So here are some of the things. The document that contains all these rules is called Circular 230. So any paid preparers or individuals giving tax advice, so if you're being paid to give advice, even if you didn't prepare the return, but you gave tax advice and got paid for it, this would apply to you. You have to sign all the tax returns that you prepare. Physically sign them. You have to provide a copy of the tax return to the client. That seems like a no-brainer, but believe it or not, sometimes that doesn't happen. You have to return all original records to the client. So they bring in their W-2 forms, you have to give the W-2 forms back to the client. You can make a copy of them, and you should make a copy of them, because that helps to document and support your position on any tax return. But the original documents have to go back to they don't belong to the preparer, they belong to the client. Exercise due diligence, that's really vague. That just means that you've got to, in everything that you do, you've got to be as accurate and precise as you can be. You can't just flippantly go through a tax return and not have any care taken when preparing it, right? You have to actually take care with everything that you prepare. It also means doing research. Like if you have a question about, I don't know if this is deductible or not. I'm just gonna put it on a tax return anyway. That's not exercising due diligence. Having the question about whether something is deductible is perfectly legitimate, but the next step then is to research it and to find an answer to your question. That would be exercising due diligence. Exercise best practices in preparing submissions to the IRS. So the IRS has some best practices that they have listed separately. Disclose all non-frivolous tax positions when such disclosure is required in order to avoid penalties. So if you are taking a novel position about, say, the deductibility of an item, and you think you are in the right, but you think the IRS might question it, you need to disclose to them, look, this is my reasoning, why I think this is the correct way to handle this. Promptly notify clients of any error or omission on a client tax return. So errors happen, obviously. Things get left out. Usually when things get left out, it's because the client didn't provide the information in the first place. But if you notice that something has been left out on a tax return that you have prepared, you are required to notify that client immediately and take the steps necessary to fix the problem. You are not required to do it for free, but would just be best practices, just from a business sense, to if you made a mistake, to fix it for free. Now, if the client left something out, that's an entirely different issue. If they didn't give you a W-2 that you had asked for, or that you didn't know existed, that oftentimes is what will happen. Is there's something out there that you don't know what you don't know, right? So clients who don't provide all the information. But if you notice that, you have to let the client know immediately. Provide records and information requested by the IRS unless the records or information is privileged. Now, normally speaking, you need a subpoena in order to release any documents to anybody, really. There are certain exceptions to that, but generally speaking, a subpoena is necessary in order to release those records. Inform a client if the client has made an error or omission in a document submitted. That would go with along with what I said before about omitting something. Pay preparers or individuals giving tax advice must not. So these are things they have to do. These are things they cannot do. They cannot take a tax position on a return unless there is a realistic possibility of the position being sustained. So this follows along with those frivolous claims, right? So one of the things that's not deductible are penalties. So if a business is late in filing their employment tax returns and they have to pay a $200 penalty, as a result of that, they can't deduct the $200 penalty. A tax preparer would know that. But if a tax preparer says, we'll go ahead and put it on there as a deduction, you can't do that because you know that it's not right? Now, obviously there's no realistic possibility that it's going to be upheld. You cannot charge a fee that's contingent on the outcome of the return or any position except in limited situations. I'm not aware of the limited situations. What this means is, and there are preparers that do this, they say, okay, my charge will be 30% of your refund. So if you get a refund of $500, I get $150. They can't do that. Can anybody think of a reason why that might not be a good idea?
That's an incentive to cheat.
Yes, it is. Yeah, now the preparers, they will do whatever they can to make sure that whatever fee they want, that's the refund that the client is gonna get, right? So they cannot charge a fee that is contingent on the outcome. Or, hey, you don't pay me anything if I don't get you a refund. They can't do that either. They cannot charge an unconscionable fee. Now, what is that's extremely vague. Unconscionable. what an unconscionable fee is in Ankeny, Iowa may be entirely different from what an unconscionable fee is in New York City, right? It's gonna be, I don't know how you would determine that, other than, you know, if it's just a W-2 and somebody's charging $1,000 to prepare that tax return, that's an unconscionable fee. You know, $150, $200, that might be more realistic, that sort of thing. But you know, who knows, in New York City, maybe that's the going rate for just a simple tax return. Things are expensive there. You cannot unreasonably delay the prompt disposition of any matter before the IRS. So if the IRS sends a notice to the client and you have agreed to represent the client in the matter, then you have to be prompt with your responses to the IRS. You can't delay. You cannot cash an IRS check for a client for whom the return was prepared. Okay. Again, that refund has to go directly to the client. You cannot represent a client before the IRS if the representation involves a conflict of interest. Again, that goes back to ethics, and you would not be able to really represent them honestly. You cannot make a false, fraudulent, or coercive statement, or make claims, or make misleading or deceptive statements or claims. So don't lie to the IRS. It doesn't mean that you can't disagree with them. It just means you can't lie. I'm not going to go through all of the specific penalties for this. Like there are all kinds of penalties, by the way. The IRS imposes. They impose late penalties. They impose penalties for non-payment, penalties for not submitting a tax return when you should have, penalties for underpayment, late penalties. You filed it, but you filed it late. And there's all sorts of different penalties. And then they'll start charging interest on it as well if it's not paid within a certain period of time. And oftentimes when a client is penalized in some way, they're oftentimes receiving more than one penalty for the same offense. So they're administrators. This is how they make their money. This is one of the ways, other than the federal government funding them, which the federal government probably doesn't do a good enough job of. Okay. Questions? Am I still going with this? Yes, I am. You can see my face peek into that if you watch that video. Questions? No? All right, so let's say we get started with Tax Act. I have not. I have sent them a couple of emails.